Hello and welcome back to All Things Money. I'm your host, David Blain, and during this final segment today, we're going to continue our discussion about diversification. If you missed the first two segments of today's show, head on over to the web, www.dlblain.com, and you can listen in there. But we're talking about diversification and what diversification means. Just kind of to recap, in 2008, 1 out of every 4, 25% of stocks on the U.S. market lost 75% of their value. That's huge. Only 4 out of over 6,600 mutual funds lost more than 75% of their value. So you can see that just owning U.S. stocks, there's a lot of risk in there. If you move to mutual funds, you can help eliminate some of that risk. And what we're talking about now is really zeroing in on what actually goes up when the market goes down, because that's what we want diversification for. We don't want to just go down less than the market. We don't want to, we want something that truly buffers the market. So generally people look to the bond market for that diversification, for that buffer. Well, with bonds yielding only 2%, say, for the 10-year Treasury, people have started to look outside the U.S. Treasury market and what I call chasing yield. And there's nothing wrong with that if you're investing for yield, for income. We think there's a better way, investing for total return. And what people didn't realize is they were introducing more and more risk in the profile. As you move away from the U.S. Treasury bonds for a U.S. investor and search for yield, you're interjecting possibly unintended risk into the portfolio. And what I mean by that, we ran the data every day since March of 2008. We looked at the U.S. stock market. When it went down 1% or more, we looked at different asset classes of bonds. We looked at short-term government bonds, intermediate government bonds, long bonds, mortgage bonds, inflation bonds. We looked at corporate bonds, we looked at foreign bonds, emerging market bonds, high yield bonds, and we also threw in there preferred stock. We made a lot of money coming out of the market decline of preferred stock. Most preferred stock is issued by banks, and there was tremendous gains in preferred stock. High yield bonds, the same thing with those. So there was a potential to make a lot of money, but my point here is that they were not diversifying you away from the equity market risk. So anyway, the market declined 197 days, or declined greater than 1%, 197 days between March of 2008 and February of 2012, yesterday, which by the way is a lot. So if you that's another whole show in itself, is talking about the volatility of the market. Anyway, so of those days in the bond market, the U.S. Treasury bonds, short-term bonds, only went down 33 of those days. It was up 160 days. So the majority of the time, U.S. Treasury bonds, short, intermediate, and long-term went up. TIPS went up 62 days out of 197, and corporate bonds went up 84 days out of 197. So you see, as you move away from pure U.S. Treasury bonds, you see that on some days the market went down, these bonds also went down. Corporate bonds, it's just a little bit better than 50-50. As you move overseas, what you see is the effects of the dollar. When the market goes down, generally the dollar goes up, and that hurts foreign bonds. And so foreign bonds, emerging market bonds, they went up less than half the time when the market was down. So they did not provide, the last 4 years, they have not provided good diversification against equity market risk, which is one of the main reasons to own bonds. Now, if the dollar ever starts to decline or the euro gets fixed or something like that, it may be a different story. But right now, when the market goes down, the U.S. dollar is going up, which is bad for U.S. bonds. The last two segments we want to talk about are high yield bond and preferred stock. These things are yielding tremendous amounts, 6-7% yields on them. However, when we look at high yield bonds, only went up 31 out of 197 days when the market went down. Preferred stock only went up 44 days when when the market went down greater than 1%. So there's virtually no diversification there, downside diversification, which is what we want. We want investments that when the market goes down, we have something that holds its value or actually goes up. So if you're looking for that type of diversification, it's not in or has not been the past few years in foreign bonds, high yield bonds, or preferred stock. Interestingly, we also looked in the growth asset classes. We looked at commodities, we looked at gold, we looked at real estate, we looked at U.S. markets, we looked at foreign markets, emerging markets, Japan, Europe, about 15 different equity asset classes. Now for this one, there were some investments not available during the whole period, so we cut down this time frame to about the past 3 years. So there was 113 days in the past 3 years that the U.S. stock market went down greater than 1%. And of those, and the point of this is that diversification, you're not going to find it by investing in foreign companies. For example, emerging markets, there was only one up day. Pacific markets, there was only one up day. Foreign small, there was only one up day. Canada, the UK, Europe, U.S. value, U.S. growth, small caps, all those, when the U.S. stock market went down, all of those also went down. They had no up days. Out of 113, gold had 45 up days. So a little bit of diversification, less than half the time. So more than half the time the market went down the past 3 years, gold also went down. AMJ, which is a pipeline, they invest in oil and gas pipelines, went up 16 days. The commodity index went up 14 days. So you see that the past 3 years, no matter where you were in any type of risk asset, whether it be an equity asset class, foreign country, large, small, whatever, in the bond market, whether it was anything high yield, preferred stock, none of those provided any diversification. The past 3 or 4 years, it's been U.S. Treasury bonds and a little bit of the gold market. So for true diversification, when the market goes down and you're looking for something that goes up, the past 3 to 4 years, it's been Treasury bonds and to some extent gold. Now going forward, that may not be the same case. And so we monitor this data on a regular basis. We look at when the market goes down, what is going up. And for the future, it may be a different asset class. But for now, looking back the past several years, it's been U.S. Treasury and gold. Well, that's about all the time we have for today. I hope you join us again next week. So for All Things Money, I'm your host, David Blain.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.